Welcome to this class. I want to share with us, based on request, liquidity concept. So by liquidity is just a term we use to refer to um, where we have previous buyers, right? Because liquidity is money. Refers to where we have previous buyers, previous sellers. So if I have a monthly chart, for instance, so I want to leave this. Let me open another chart. If I have a monthly chart, let's just go ahead and use this. So liquidity in this regard has to do with where we have previous buyers and previous sellers. So this is liquidity. This is liquidity. All right. So these are liquidities here. So it depends on where price is going to, because price moves from one liquidity point to another. If price takes this liquidity and price remains bearish, the next thing price will create another liquidity and go to take it. So that's the movement of price. You will find price doing something like this. So if price is bearish, as I said, we have something like this. Price takes this liquidity. The next thing I'm expecting is that price will take these lows if price is bearish. Price takes that low. So this was a previous liquidity captured. After taking that, price came and captured this liquidity, left this, created this liquidity, went up, came back and captured it. So if the market remains bearish, I would want price to come and capture this liquidity. Okay, so liquidity concepts just talk about where we have previous buyers and sellers, where price will be attracted to. So since we are bearish, price has created this low, price will come back to capture, to take it out. So we expect that price goes up, capture this previous, this can be either a previous weekly high or previous daily high, previous monthly high, takes it out, and then price comes to take this out. So if price still remain bearish, we want to see this low that was created. If price starts pushing higher, possibly price can capture this with a wick and go lower, or trade up this zone and capture it. So all these previous buys and selling axes or points are all liquidity, because that's what engineers what moves price in the market. So let me just take you and show you a few things. Okay. So from this point, price was bearish. Okay, this is a weekly chart. So disregard what is on the other side. Let's just focus on this. So price was bearish here. This was where price started from. Price started from here and sold down for weeks. Each candle here represents a week. So where is the liquidity point we are looking at? This is the point. Since we are bearish, this is the point we are expecting price to come and capture. This point, it might take days, it might take weeks, but that's the point. That's the liquidity there we want to trade off. So immediately you saw price being bullish. Look at what price did before price went bullish. Price came to this zone, captured this. This was liquidity because this previous weekly low, which was the previous Monday low. You see how that price took it out and price went up. Price came and took out this other week. Look at it. That was a previous weekly high. This was a Friday high. This was a 9th of November low. This was a Monday 22 high. Price took it out. And price will give you that from price took it out. You can see all the weeks happening here, the rejections. So price took this liquidity. The next liquidity, immediate liquidity, as price took this liquidity, if you were to sell, you want to look at this low. That's the immediate liquidity. See what price did? Price took it out, went up. When price went up, now we have a fair value gap here. Price didn't need to come here because we have a structural zone here. This was the next liquidity to be captured. That high. Price took out that high, and you can see how that price clearly closed below. That was Monday's second high. So this was a liquidity point, a previous Monday high. All right. Price taking out that previous Monday high. The next liquidity price we go to is the lows. If price takes the high, price takes the low. So in the next video, I'll be telling us internal and external liquidity, and then I'll be trying to differentiate them for us. But if price takes this high, price should go and take the low for that week. So this was a Monday second high. This was a Monday lows. Price took the high, closed clearly below it, and price took the lows. So when price took the low, that was the candle that took out this low. This week, candle took this low. The next week created this high, created this low. So next week created this high, created this low. The second week took the low, couldn't take the high. The next week, 18th, created the high. Look at what price did when price came there. Price took the high. This was a Monday high. The next Monday, 25th, price took the previous week high and closed below. So as price closed below, price should go and take this low, the last week low. That's what price went for. After which price dropped heavily, and the last low that was created was this low. Price started looking for opportunities to go higher, coming to tap in all of this. Then watch what happened here. Price came back, took out this previous high, previous week high. Price rallied up, took out this previous week high also. This long candle came after taking out this high. Price took the lows with this long candle. Then price created another new low, went up, created a double top, and the next week took that high. Since we are bearish, you want to always look out for price taking the high and price running to the lows. Beautifully, price took the highs and ran to the low. So that's the next low to be captured, liquidity. That's how you can simply be following price, right? Now price has taken the low with this candle, and price clearly closed inside. So you want to see what price is going to do. Is price going to capture the next high and we run down? Or in this scenario, price didn't capture the next high, price closed inside and price ran to the downside. When price ran to the downside, the next candle created the doji, created all of this low. We want another high that will be swept, and then you can get in to take the low since we are bearish. Look at the next week. These candles started pushing up. When this low was created, price came, created this high, closed below. This was created. Look at this candle, a pin bar, went ahead, took out all of these previous weeks. This week, this week, this week. All the highs were captured by this singular candle, and you can see the information. It closed far inside, giving you a signal that the sell is fully ready. It's a pin bar weekly. So all throughout this week, you'd have been able to get in to come and take this next liquidity. Then from there, price, kept pushing. So this is what liquidity concept is all about. You want to see price. If we are going to be bearish for the day, you want to see price create this low, take previous low and fall. If we are going to be bearish for the day, and if we are going to be bullish, you want to see price take out previous weekly lows and we go bullish. If I'm going to be bearish, price come to either take out the previous highs and we go to the lows. So this liquidity can either be, so let me put this now. These liquidities can either be previous daily high, previous weekly high, no, previous daily low rather, previous weekly high, previous weekly low, previous monthly high, previous monthly low, previous H4 high, previous H4 low. So these lows could also include Asian high and Asian lows. Asian highs and Asian lows. These are all liquidity points. So price is designed in such a way that if we are bullish, price will want to look for liquidity sweep, and that is where smart money concept comes into play. Price taking previous lows and breaking above. So we have something like this. You want to see that price comes back to play either the breaker block or the fair value gap. Yes, price either comes to play the breaker block. You want to be on the lookout for it. So guys, that will be all for this video. Tomorrow I will take us through internal liquidity and how you can spot them and how we can use them on the charts. Please don't forget to subscribe.